Okay, let's just jump right in and anchor our brains to a totally mind-bending number, $5 trillion. To really grasp the sheer, unprecedented scale of Nvidia right now, you have to realize that at this market cap, this single company literally outweighs the entire economic output of major global economies. We're talking about eclipsing the nominal GDP of the United Kingdom at 3.84 trillion and France at 3.21 trillion. It is a financial anomaly that absolutely demands our attention. So welcome to The Explainer. Today, we're unpacking NVIDIA's fundamental financial metamorphosis. We're going to dive deep into the numbers behind their massive shift from gaming to data centers and objectively evaluate what's really propping up this valuation and whether it's actually sustainable. Here's our quick roadmap to make sense of the hype today. First, the $5 trillion Titan. Second, gaming to data centers. Third, the AI cash machine. Fourth, the trillion-dollar moat. And finally, innovation or AI bubble. All right, part one, the $5 trillion Titan, sizing up the market anomaly. To understand this anomaly, we really have to look at the sheer velocity of the AI boom. Think about this timeline. Nvidia surpassed the $1 trillion mark in 2023. Fast forward to July of 2025, they hit $4 trillion. And then literally just a few months later, in October 2025, they crossed the $5 trillion threshold. They quadrupled in value in essentially 2 years and now account for roughly 7.3% of the entire S&P 500 index. This isn't just standard growth. It's a complete financial metamorphosis that has heavily propped up the broader American stock market. Moving on to part two, gaming to data centers, the ultimate pivot. Historically, we all knew Nvidia as a consumer gaming hardware company, right? But the imbalance today is just massive. If we look at their third quarter fiscal 2026 revenue, a staggering 90% of their $57 billion in quarterly revenue now comes directly from data centers. Gaming? That's down to just 8%. They've successfully executed the ultimate pivot from consumer electronics to becoming the foundational pick and shovel provider for the entire AI gold rush. And this shift has profound financial implications. Instead of relying on the highly cyclical, hit-driven gaming market, their revenue is now propelled by massive, long-term corporate investments. Tech giants and sovereign nations are practically racing to build massive infrastructure, what NVIDIA CEO Jensen Huang likes to call AI factories. This makes their income stream far more stable and fundamentally alters how Wall Street values the entire business. Which brings us to part three, the AI cash machine and their unprecedented profitability. $102.7 billion. That is the jaw-dropping amount of operating cash flow Nvidia generated in full fiscal 2026. Because they command immense pricing power for these high-demand AI chips, and because they operate a fabless model, meaning they outsource the actual physical manufacturing, their gross margins are hovering near 75%. They are turning top-line revenue into cold, hard cash at an astonishing, near-perfect conversion rate. To put that profitability into context, just compare Nvidia against the other tech titans, the so-called Magnificent Seven. Their dominance is striking. Nvidia boasts a near 60% operating margin. That's well ahead of Meta at 44%, Microsoft at 43%, and it completely dwarfs Amazon's 10%. This demonstrates an exceptional industry-leading ability to convert revenue into pure operational profit. And that actually leads us to a really fascinating reality about the sustainability of their current valuation. Despite hitting a $5 trillion market cap, their forward price-to-earnings ratio has actually compressed. Let that sink in. In January 2022, they traded at a massive multiple of 80 times forward earnings. By January 2026, that compressed all the way down to 24.7 times. Paradoxically, their actual earnings have exploded so fast that the stock is technically cheaper relative to its profits today than it was before the massive AI boom even began. The market is pricing in incredible growth, sure, but the underlying cash generation has, so far, completely kept pace. Part 4. The trillion-dollar moat and how they defend this empire. With margins that high, competitors are naturally circling. But as one savvy and pretty funny retail investor pointed out online, the secret to NVIDIA's resilience goes far beyond just building fast chips or CEO Jensen Huang's iconic leather jacket. The hardware is literally just the visible tip of the iceberg. The real defense lies in a deeply entrenched ecosystem. The absolute bedrock of this moat is CUDA. Introduced way back in 2006, this is NVIDIA's proprietary software platform that allows developers to easily program GPUs. Today, millions of developers and almost all major AI frameworks are completely locked into the standard. it creates a self-reinforcing monopoly. If a company wants to switch to a competitor's cheaper hardware, they'd have to spend months and millions of dollars rewriting billions of lines of heavily optimized code. The switching costs are just astronomically high. And they brilliantly complement the software lock-in by controlling the entire hardware ecosystem. Yes, Nvidia holds over 90% of the AI chip market, but they don't just sell standalone chips anymore. They sell whole DGX supercomputers. They sell data processing units, or DPUs, to handle the complex networking. They rely on highly specialized advanced packaging from TSMC. Basically, they're turning the whole data center into one cohesive Nvidia engine, making it incredibly difficult for rivals to compete by just offering a single alternative chip. Which brings us to our final section, Part 5, Innovation or AI Bubble. Let's talk about the systemic risks. Look, even titans have structural vulnerabilities, and impartial market skeptics are raising some valid red flags. Nvidia faces severe concentration risks. First, a staggering 61% of their revenue comes from just 4 massive tech companies. If even one of those customers scales back their data center build-out, Nvidia's revenue would take a massive hit. Second, they have a 90% manufacturing reliance on TSMC in Taiwan, creating a highly fragile geopolitical bottleneck. And finally, forecasting demand for this tsunami of computing is incredibly difficult. Overproducing could quickly lead to billions in unsold inventory. And the threat from those top 4 customers, the hyperscalers, goes even deeper. Companies like Google, Amazon, and Microsoft are actively trying to break their reliance on Nvidia. They're aggressively designing their own custom AI chips to lower their massive data center costs. While Nvidia absolutely still has the performance and software edge today, the reality is that their biggest clients are actively funding their own long-term replacements. This is, without a doubt, the most significant structural threat to Nvidia's future margins. These structural risks build into even broader financial concerns. Skeptics point to some really complex circular investment loops. For instance, reports highlight a cycle where Nvidia invests heavily in an AI startup like OpenAI. OpenAI then turns around and purchases massive cloud compute from a provider like CoreWeave, and CoreWeave uses that incoming cash to, well, buy more Nvidia GPUs. This kind of structure raises some serious questions about whether a portion of this massive demand is being artificially catalyzed by Nvidia's own balance sheet. So, with customized chips rising, fragile supply chains, and complex financial loops at play, we're left with a critical question to ponder. As we watch this historic financial transition unfold, from gaming hardware to the epicenter of the data center, are we looking at the permanent, sustainable bedrock of a new technological era, or an over-engineered $5 trillion bubble just waiting to burst? Thank you so much for joining me for this explainer. Keep asking the hard questions and keep learning.